mine recently told me how he had fixed a leak in his water heater. Now, I've never heard of anything like that because you never replace a water heater because it's going to continue leaking. You never fix a water heater, you always replace it. However, if you haven't saved enough money for retirement, you have to make some shortcuts. Don't let this happen to you. I'm going to share some basic principles in investing so you can end up with a more secure financial future. Okay, first principle is that of compound interest, which Albert Einstein says is the greatest mathematical discovery of all time. Now, if I take $10,000 and I invested at 5% for a year, I'll end up with $500 in interest. However, if I do that the second year, I'll get an additional $500 interest on the $10,000, but I'll also get $25 in interest on the $500 in interest from before. And you can see how this keeps growing so that the amount of money you get each year keeps escalating. So the longer you hold something in an investment, the more rapidly it's going to grow. Say I'm 25 and I say, well, I'm going to put away $10,000 for when I retire at 65, and I invested at 5% interest. When I'm 65, I now have about $70,000. However, if I say, I'm not that close to retirement, I'll wait and do that later, and I put that $10,000 away when I'm 50. Then, when I'm 65, instead of having that whopping $70,000, I only have a paltry $20,000. So the moral of the story is start investing now. Additionally, if you start investing now, you have broken the barrier of starting to invest, and it's easier to kind of increase your investment and have everything snowball so that when you're retired, you will be much better off financially. So a key issue on investing is an issue of risk tolerance. And there's sort of the issue of a personal risk tolerance versus a situational risk tolerance. Now, what I mean by personal risk tolerance is that if you have an investment that is keeping you up at night worrying about whether it's going to go south on you, then you're taking too much risk. You need an investment that is much more soothing to your nerves. However, a situational risk tolerance is something where your situation has changed. If I am young and I invest a large portion of my portfolio in something that is risky in the hope of getting a reward, and that goes south on me, then I have a long time to recoup that. That I can maybe invest a little bit more, I can work a little bit longer. However, if I am close to retirement or have retired, then that's it. I can't recoup that. I need that for when I'm old and decrepit like I am now. So your risk tolerance, you can do something that is more risky when you're young than when you get to your retirement age. So what are the types of investments you can put your money in? There are two types. One is your fixed income investment, which is bonds, which is certificates of deposit, which is money market, and the other is equities, which is where you're buying ownership of something that is hopefully going to go up in value or spit out some income, such as stocks or real estate, something like this. So which one is better? Well, over the long run, equities are going to do better than fixed income. Otherwise, people wouldn't invest in these, because why invest in something that's going to go up and down if you're not going to be able to do better than something that gives you a assured return? So, okay, I've decided that part of my portfolio is going to go in equities. How do I choose a stock? Now, I personally have sort of a stupid investor type of mentality, which is that as I'm analyzing a stock and I'm trying to guess whether a stock is going to go up, I'm competing with all those other people that have greater expertise than I do, and chances are I'm not going to be able to outguess them. So for me personally, what I prefer to do is I prefer to put money in a mutual fund. Mutual fund is a company that invests in a wide range of stocks that hopefully are going to go up. Now, if a company is investing in a number of stocks and doing a lot of research, they're going to charge you a fee, which typically is maybe 1% of the amount of money you have invested. Another alternative, which I prefer, is more of an index fund, which an index fund is something that mirrors some index of how the stock market is doing. For example, the Vanguard Standard & Poor's 500 Index Fund mirrors the Standard & Poor's 500 Index of the stock market. When someone buys some more of this, they will go out and automatically buy some more of the stocks that comprise the 500 Index. If someone sells, they will obviously sell some of these. As a consequence, because they are doing everything automatically, their fees for giving you this broad range of market diversity is very, very low. If you have $10,000 in there, they're charging you only $500. This would be $5 a year. So, bottom line is, start investing now, develop a rational plan, and stick with it. And your financial future can be much improved and be part of your own personal Shangri-La. However, if you choose not to invest now, please see me later and I will show you how you can fix a leak in a hot water heater.